how to design business portfolios and growth strategies for companies. In order to do that, companies use BCG Matrix or Boston Consultancy Group Matrix. If you would like to understand how it works and when to use the BCG Matrix, like the video, subscribe to the channel and leave a comment in the description for YouTube algorithm, and let's go with the video. First of all, let's understand what the business portfolio is and why do you need it. Well, the business portfolio analysis is a part of a marketing concept that is called strategic planning. If you'd like to learn more about the strategic planning, there is a video about that in the description below. In the strategic planning, there are 4 steps: defining the company's mission statement, setting objectives and goals, designing a business portfolio, and developing functional plans. Guided by the company mission statement we talked about in the first video and supported by the objectives and goals every company has, the company now has to design and has to analyze the business portfolio that it offers. So the business portfolio is all the products and all the services that a company has, and in this step you design it the best in order to fit the strengths and the opportunities you have in the market, so a company can plan for its growth in the long term. In order to do this, a company must analyze the current business portfolio it has, so all the products and services that a company has to offer, and then develop growth and downsizing strategies for the products in order to best fit the market opportunities there are and the strengths of the company. So basically, the company allocates resources on which products should be promoted more, which products should be developed in order to produce the best profit. The business portfolio is the collection of businesses and products that make up a company. Most of the times, the bigger a company is, the bigger the portfolio they have is as well. Let's see an example. GE. Most consumers know GE for its home appliances and lighting products, GE Home and Business Solutions. However, GE owns more company units such as GE Transportation, GE Aviation, GE Gas and Oil, GE Healthcare, and many others. This company, GE, is a giant of $146 billion, and they offer solutions and products starting with jet engines to wind turbines and also medical equipment. So you can imagine that for such a company, they need to have a clear plan how to allocate their resources for every company unit. As you can imagine, it is quite hard for a company to design and manage such a big business portfolio when the company has such a size. This is why the marketeers made the business planning of the portfolio in 2 steps. The first step is analyzing the current business portfolio. So here the company determines which businesses should receive more, less or no investment, and the second step is it must shape the future portfolio by developing strategies for growth and downsizing. The most important activity in this process is the portfolio analysis, and this is the process by which management evaluates the products and businesses that make up the company. Just a quick reminder, you don't need to write down any notes or any definitions that you will see in the video. In the links down below in the description, there is a free downloadable that has all the definitions of all the marketing terms I use in this video. Feel free to download it for free. Obviously, every company wants to make profit, and in order to do that, they need to know how to allocate their resources. So this means they want to know in which products or services they should invest money, because those products and services generate them the best and the most money, and then they know what downsizing strategies to use for which products. So they need to know what products are a cost for them and don't generate any profit, so they can drop them off. Well, in order to do that, the company identifies the key businesses, and we call the key businesses SBUs. The SBU is a key business that makes up the company's strategic business unit. It can be a company division, a product line within a division, or a single product or brand. The purpose of strategic planning is to find ways in which the company can best use its strengths to take advantage of attractive opportunities in the environment. Therefore, companies evaluate SBUs in 2 dimensions. The first dimension is the attractiveness of the SBU in the industry, and the second dimension is the strength of the SBU's position in the market or industry. This is how we get to the BCG Matrix, the Boston Consultancy Group Matrix, and it was developed as a way to assess all the SBUs of a company, and so far it's known as one of the best methods to do that. The Growth-Share matrix is a portfolio planning method that evaluates a company's SBUs in terms of market growth rate and relative market share. So it has two axes. The vertical axis is the market growth rate that provides a measure of market attractiveness. The horizontal axis is a relative market share that is a way to measure a company's strength in the market. Basically, what this metric does is that it classifies all the SBUs of a company in 4 categories. It has stars, it has question marks, it has cash cows, and it has dogs. I know it looks more like a dinosaur, but let's suppose it's a dog. So all these 4 categories represent types of SBUs a company has, and let's analyze each one of them independently. Stars are high growth, high share businesses or products. They often need heavy investments to finance their rapid growth. Eventually, their growth will slow down and they will turn into cash cows. The cash cows are low growth, high share businesses or products. These are established and successful SBUs that need less investment to hold their market share. They produce a lot of cash that the company uses to pay its bills and support the other SBUs. The differences between the stars and the cash cows, they both have, so let's start with what they have in common. They both have a big market share. What they don't have in common is the growth, because stars are high growth and high market share in the same time. The stars are usually, well, newer product that's selling a lot of units in a small period of time, while in the same time the cash cows have a slow or a low growth rate, because they are usually big products or big companies, big SBUs that cannot really grow anymore. Let's take as an example Facebook. Facebook, well, not the company, the product, let's consider Meta to be the company, has Facebook as a product. Facebook is a cash cow, and why? Well, it has a big market share, right? Everybody knows about Facebook, but it has a low growth rate. So because Facebook is so big, it has like how many billion users, it cannot really grow anymore, or it can grow but not that much. When you have the majority of the growth possible in the industry, you cannot grow that much anymore. So what Meta did was to buy Instagram and WhatsApp, for examples, which were stars, because they had already a big market share, but they were rapidly growing. Because when you are a smaller product, 15% of what you can grow doesn't represent that much in comparison to Facebook, right? When you take a cake, if it is a bigger cake, 10% is a huge piece of cake. When you have a smaller cake, 10% of that cake, it's way smaller than the 10% of a bigger company. Actually, most of the times 10% of a cash cow can be an entire star, right? If you think about numbers. So what Facebook did, what Meta did, was to take the money Facebook generated and invest it into the stars, into Instagram and WhatsApp, to grow them even more, as much as possible. So they turned them into cash cows, right? So Facebook is the cash cow, Instagram and WhatsApp, because they were rapidly growing, they still had a lot of place to grow. They invested money in them and transformed them into cash cows. Going on, we have question marks. They are low share, high growth. They require a lot of cash to hold their share and are usually hard to increase. Management needs to think if they can try to build it into stars or not. Let's see an example of a question mark. In our days, it would be Tesla, the car company. And why? Because at the beginning, they were rapidly growing, right? So they had a big growth rate. They were selling a lot of cars, more and more cars, but they had a low market share. So in comparison to the entire industry of autos, the number of cars Tesla was selling and the money they were getting was basically nothing compared to the entire industry. So this means that they didn't have a big market share. This is why Tesla is a question mark. And Elon Musk had to think if he can invest a lot of money into the company. So you know that the company was already selling cars, it was producing money. Most of the times question marks don't produce enough money to sustain themselves. And this was the case as well for Tesla. So Tesla was selling a lot of cars, but they were not selling enough to sustain themselves. And Elon Musk had to think if he can invest that much money to transform the question mark into a star. Most of the times this action is not realistic. Most of the time these investments cannot transform a question mark into a star, because when the industry is big, having a market share within it takes a lot of money. And finally, there are dogs. Dogs are low growth, low share businesses and products. They may generate enough cash to maintain themselves, but do not look very promising in the future. Everybody can understand dogs. We look at our little dinosaur here. It has a little market share and a little growth rate. Basically, it's a product. Let's think about an SBU as a product. An SBU again can be a company or a product line. They don't produce that much money. Most of the times, hopefully it can sustain themselves, but in the long term, companies don't really see a strategy to grow that product into something that can be a cash cow. So what the Boston Consultancy Group did was to create the BCG Matrix so companies can assess their business portfolio. They can finally assess all their products and services, business units, SBUs as we call them, in order to understand where their money should be invested, if it's worth it or not. Because think about it, when a company is so big, like let's say Coca-Cola, they need to know which products are stars, which are dogs, so they can handle their money and invest them in the most profitable way. So at this point in time, a company has already used the BCG Matrix and it knows where their products are and what the business portfolio looks like, which are the dogs, which are the question marks, the stars and the cash cows. Well, the next step is to design a strategy for the long term, for the future. And there are 4 strategies that a company can use. It can invest more in the SBU to build its market share. It can invest just enough to hold the SBU's share at the current level. It can harvest the SBU, milking it for short-term cash flow and not caring about the long-term effect. Or it can divest the SBUs by selling it or phasing it out and using the resources elsewhere. As the time passes, most of the SBUs can change their position within the matrix. This is why companies perform this matrix, well, most of the times annually, but they can do it more often as well if it's a big company, because most of the products, they will start as question marks, right? So they don't have a big market share, but they have a rapid growth. If the company is powerful enough to invest a lot of money to sell the product or the business unit, but they don't know if they can invest it enough to transform it into stars, or if they will have a cash cow in the long term. Later they become cash cows and finally they die or turn into dogs. So this is like the life cycle of the SBUs. If the question mark is successful, it transforms into a star because it starts to have a lot of market share. And if it's a successful star, it will turn into a cash cow. But all the products die at some point. They will not be used anymore if there is no innovation. So at some point they will die out or they will transform into a dog. And because these products will die out at some point or they will transform into a dog, what a company needs to do is to constantly come up with new products and new services and have a new business portfolio that they can prepare for the future. So what I just explained you is how the business portfolio analysis works and how the BCG Matrix works. Obviously, there are also some problems that some companies observed by using this matrix, and I think it's worth mentioning them. So let's see problems when you use the BCG Matrix. This matrix can be difficult, very time-consuming, and costly to implement. Management may find it difficult to define the SBUs and measure the market share and growth. Classifying current businesses offers little advice for future planning. For all these reasons, some companies went for other approaches. In the same time, the entire marketing industry was revolutionized, so they found out new matrices that they can use and new matrices that they can use for their specific industry. To understand it better, in former approaches, the decision makers were, well, the senior managers. They were deciding the direction of the company, they were deciding everything that happens with every product and service. Although if it was a big company, you can see why having a lot of variables was not really good to be decided by a group of people. So this is why nowadays it's been decentralized. So this means that managers of several teams in several divisions of departments have now authority over strategic planning. So basically they designed the market department leader to be in charge of the marketing strategy. They made the department leader of the sales department to be the leader of the sales. So it's not just the owners of the business designing the entire strategic planning. Now it's decentralized, using the leaders and the team leaders that they have for every department. In 1980s, the Walt Disney Company was seen as a theme park. Everybody knew it for Mickey Mouse and for the theme park. They hired a company to handle their growth and market share and the direction for the next 20 years. And what the company made is to become a giant. So nowadays, the Walt Disney Company has Walt Disney Pictures, Pixar Animation, Marvel Studio, Disney Channel, parts of History Channel, and many others, and other businesses and SBUs are part of the Walt Disney Company. This is how effective planning can be for a company. It can literally turn a small company or a medium company into a giant. If you would like to do this with your company as well, in the description below, I created a marketing and communication plan that you only need to fill in with the company data of your company and create your own strategic planning. You can download it in the description, check the links. Thank you for watching this video, I hope it helped you. If it did, like the video, subscribe to the channel and leave a comment down in the comment section for the YouTube algorithm. You know how it is nowadays. If you liked it so much, you can also buy me a coffee. I run on a lot of coffee to create these videos. And don't forget, check all the links in the description. You will find more videos for you to learn more marketing. If this was helpful, check out the other videos on the channel, and I see you at the next video.